with chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Chief Investment Officer at B.I.G. Investment Services. That's B.I.G. Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come. Trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, January 2nd, 2026. Happy New Year, everybody. Hope you all had a wonderful holiday season and a happy New Year. We're not going to jump deep into the weekly numbers this week because we want to give you our 2026 outlook. I will say this, Santa Claus acting like a bum. Santa Claus rally fizzling out, not really happening at the moment. There's a couple of days left. We'll see how it finishes. But the S&P 500 was down 1% this week. All the other major indices down as well. Silver, for folks been tracking that, we talked quite a bit about it last week, down 7.5%, negative 7.5% this week. So it looks like that really got smacked in the face. That's no surprise. I kind of expected that to happen. There's more about this Santa Claus rally that's concerning, and I'm going to circle back around to that in a moment. Let's talk a little bit about 2025 before we jump into 2026. The S&P 500 finished up for the third consecutive year, up double digits, around 16.5%. I've got clients been asking me, David, look, we finished up in the 20s. We've had a really good year here at B.I.G. So when you beat the S&P 500, it gets people's attention. So some clients have been saying, hey, are we being too risky? So I just want to address that for a moment before I jump into this because we did have a great year. No, we're not. There's a measurement that we utilize on portfolio management called beta, B-E-T-A. And what it is, it's a measurement of volatility. The S&P 500 has a beta of 1. So that's our comparison, right? 1. Our betas for our models all year long have been running around 0.7 down to 0.55. Say a third to half of the volatility of the risk of the S&P 500. So we're not taking on additional risks to get these returns. What's happened is we've just been kind of timely with some of our moves, and some of the stock selection has really helped us out. So if you recall, the first quarter of last year, the market did not perform that well. And by the end of March, it looked like something was about to break. We raised up about 20 to 25% in cash for all of our models based off of technical indicators that we were really concerned about. And then the tariffs were announced, the market tanked down about 19%, and we took a lot of that cash and put it right back to work within a couple of weeks and bought a lot of stocks right down there near the bottom. So just having some timely moves as far as money management, taking some risk off the table when things didn't look good, putting it back to work when things look stretched, that helped a lot. And some of the individual holdings we've had have just had really monster years. We added some money to Europe and Southeast Asia, put some money overseas on the very beginning of the year last year, January 3rd. All that helped out a lot as well as overseas investments did quite well. So we're not taking on crazy risk. We're not gambling with your money to get returns in the 20s. We're just being mindful about where the market is, making adjustments as we go, and trying to pick out really good investments that we feel can give us some outsized returns. So we've beaten the S&P 3 out of the last 5 years, and you start to wonder what's going on. We've just been blessed with some good timely moves and some good holdings. So with all that said, thank you 2025 for making all of our clients lots of money. Let's talk about 2026. And I'm sad to say that I am going to be David Downer tonight. I do not have a good outlook for 2026, not at all in any way, shape, or form. Now, I'm not expecting things to go off the rails and a massive crash and all these types of things. But I have to tell you that this whole thing is a matter of probabilities. Is the market likely to go higher? Is it likely to go lower? And it's a weight of the evidence approach that we try to take. And we look at history sometimes as a guide. Of course, history is no fortune teller. You can't bank on what it's done in the past to be sure about what it's going to do in the future. But you can certainly take a look at previous times in history and similar markets. What did they do? How did they act? Because human psychology stays rather consistent regardless of what markets do. And there's quite a few things that have me concerned. First of all, the market is just stupid expensive. It was expensive coming into 2025. We talked about that. We pulled some money out, put it in Europe, put it in Southeast Asia. It's even more expensive in many ways coming into 2026. As a matter of fact, when you go back and you take all the different valuation metrics, things like the Cape-Shiller, the Buffett indicator, the forward PE of the S&P 500, it's in the group of the 4 most expensive markets in United States history, ranking with 1929, 1966, 1999, and today. And if you know anything about market history, you know 1929 and 1999 were not good times to be in the market. 1966 was really bad also. It was a really bad time period moving into the early 70s. So 3 other sister periods here with these types of PE valuations, markets did not perform well. But there's more than just that. We're going into a midterm election year. The average drawdown in a midterm election year, the average, is negative 19%. That's the average decline during the course of the year. Okay, the average decline, let's just take out first-term presidents and go with second term, because Trump's second-term office. The average decline for second-term presidencies, 14.3%. So it doesn't really matter if you're in a second term or the first term, you're down double digits pretty substantially at some point in time during the year. But here's what really stinks. The average gain for midterm election years is only 4%. So it's not really stellar with really big drawdowns in between. Now, the following year, markets tend to be incredibly strong, average gain around 16% or so post-election. Next point, we're going to get a new Fed chair in May of next year. Now check out this statistic. The average decline in the market during the first 6 to 12 months of a new Fed chair is 15%. 15% decline some point in time during the next 6 to 12 months from installing a new Fed chair. And Jay Powell departs his position in May, at which time we'll get a new Fed chair. Next point, 3 years of double-digit gains. That's what we just had, okay, in the stock market. 3 years of double-digit gains. When you've done that, when you've had 3 years of double-digit gains, the following year, the average gain, 4%. That's right in line with the midterm election average gain. Out of the times that it's happened, it's only been 11 times. We've had 6 up years and 5 down years and an average negative decline for the year, negative 11.8%. There's only been 3 times in history where the market made double-digit returns 4 years or more back-to-back. It's only happened 3 times in the last 85 years. When you look at all the other weight of the evidence here stacking up against us, I don't think it's going to be the 4th time that we have 4 years of back-to-back double-digit gains. I just don't think it happens. I don't think it does. That said, we just crossed the 3rd year of a bull market. Once you get past that 3rd year of a bull market tends to last on average about 6 years, okay? So that would indicate that there should be a little bit more time in front of us as far as this bull market that we're in. It could be a nasty year, it could be a choppy year, but it doesn't necessarily mean that we're going to go into a bear market type of situation. There's 4 years when the market didn't really hold up well, 1946, 66, 70, and 2020. 1966 kind of shows up on quite a few things I've been measuring. Things didn't go so well during that period of time. Now, I mentioned a moment ago about the Santa Claus rally. There's a period of time between October and January. I can't give you the dates because I got competitors that listen in, and this is just too powerful of a tool. But there's a specific date in October and a specific date in January that tends to be the strongest period of the year, going all the way back to 1950. So out of those 75 years, of the 10 worst of those, the market was down 6 times, 10% or greater. It was flat 2 times, and 2 times it was up 9 and 14%. So out of the 10 worst of those periods from 1950 to now, from October to January, I can't give you the dates, but you're tracking with me, right? Of the 10 worst periods, down 6 times, down 10% or more, flat twice, up twice, 9 and 14%. Right now, we will be in one of the worst 10-year periods ever from October to January on that metric, if things don't change in a couple of weeks. So that is another thing that we're watching, just another little technical thing that is just showing up in our face here that there could be some concerns. Now, look, there's some technicians out there like Larry Williams. I follow his work. He's fantastic. He's expecting a good year in the market, some choppiness, but he's still expecting it to push higher. And look, I'm not saying that it can't. You've got this AI trade that's continuing to rage on and do quite well. But look, there's some other things I'm concerned about, and I'm going to take this a step further, and I really don't want to blow your minds up here or scare you. I'm not trying to scare you here. I'm just trying to be real. That's what you want. You want to know what to expect. There's cyclical bear markets and there's secular bear markets. Cyclical bear market is a short-term bear market, usually happens in the midst of a long-term bull. We had one back in 2022, right? It lasted a year and was over. Secular bear markets are long lasting. We're talking 10 years and longer. Think 1999 to 2009. The market was negative over that 10-year period. We've had a few of those throughout the United States history. We've had like 4 major secular bear markets. There are some things that are just flashing on my radar screen right now that line up with periods of time prior to the other secular bear markets that we've had. Peak concentration in the market. Where's all the return? It's in a handful of stocks, the Mag 7, the Great 8, whatever you want to call it. There's a few stocks making all the money. We had peak concentrations in 1905, 1937, 1964, 1999. They all ended badly. Junk bond spreads. That's the difference between low credit quality bonds and United States Treasuries. We hit 2.5% spread on January 2nd of last year. There's only 2 other times that we've ever been that low since we've been measuring this, 1997 and 2007. If you know anything about market history, you know things didn't go well after either one of those periods. We went into the tech crash after 1997. It was a couple years later. We went to the great financial crisis after 2007. It was a little over a year later. Extreme low unemployment with a high PE on the S&P 500. Extreme low unemployment with a high PE. That's a really bad place to be. It's happened only a handful of times in our history. 1929, 1966, 1969, and 1999. And we're here now. Now, we've been here for a while, which is interesting. I think that the COVID money has kind of distorted some numbers there, but we've been here for a while. Here's a big one. When margin loan debt, now margin loans are when you borrow against your stock portfolio. When the growth of margin loans surpassed the growth of the S&P 500 earnings by 5% or more, bad things happen. Bad things happen. Last year, margin debt grew by 40%. The S&P 500 earnings grew by 18%. When it surpassed 5% or more in the past, like 1999, 2007, and 2021, bad things happened. So look, I've been thinking for a while that the next secular bear market may be looking like the early to mid 2030s. We've got really strong demographics for the millennials. We've got this artificial intelligence build out that's happening right now. We've got a lot of things, robotics and lots of different things that are kind of shaping up to maybe propel us forward for a while longer. So 2030s have been on my radar, but I have to tell you, this data that I've been researching has really kind of got me a little bit more defensive, a little bit more concerned. Now, we're not going to act like we're getting ready to enter a secular bear market. Secular bear markets are nasty. They last 10 plus years. Now, you can make money in them. In the early 2000s, during that secular bear market from 1999 to 2009, we made plenty of money for our clients just by working with the movements in the market, buying when things got washed out, selling on rebounds, and having a lot of money in things that were paying nice dividends and interest and things like that. So we did just fine. So you can make money in a secular bear, but it's not easy and it can be a scary time. I'm not saying that we're going to enter into one, but we are on watch for it. Okay. We are on watch for the next secular bear market. There's a key technical indicator that I follow very, very closely. There's a couple key technical indicators I follow very closely. One of them we acted on in March and we made lots of money on it. We did the same thing in COVID in 2020. We did the same thing in 2022. There's another one that's even more powerful that we watch very, very closely. And if we break that technical indicator, it could absolutely spell trouble for secular bear market. So we're going to act like that's not happening until it does, because that's how you manage money, right? You have to work with what's in front of you. So if we get dips in the market that are extreme and a little scary, we'll look to do some buying and things like that. And we're going to continue to operate that way until such time that this technical indicator breaks and indicates that secular bear market may be underway. In which case in time, that's fine. We can buy that move pretty strong. There's going to be a big rally off of that. We'll sell it and we'll position ourselves moving forward as a secular bear market and we'll do just fine. recession, I tell you, I don't see things shaping up to really point to recession. There are plenty of things. Don't get me wrong. There's lots of stuff that points to recession, but the things haven't been working. They've not been working since COVID money, since we printed $6 trillion and just dumped it into the economy and just drowned everybody in cash. These indicators have not been working. So there's lots of indicators that say, hey, recession, you should be worried about it. But there's a lot of stuff that says it's not happening right now. One of the things that a lot of economics professors will teach you in universities is that the stock market can predict recession 6 to 9 months in advance. Managing money in the market, I've come to disagree with that strongly. I don't think the market predicts a recession 6 to 9 months in advance. I think it causes it. I think when markets crash, it causes recessions. At least it has a strong potential to. We got lucky we didn't get one in 2022, but we got real doggone close to it. And the market was really causing that. When people lose a lot of money in the stock market, they tighten up the purse strings. They don't want to spend the money. They get concerned. They get afraid. And I think that leads to recessionary activity. So what I'm kind of looking for or watching for is if the market does get ugly, if it takes a negative turn, that could lead to more economic trouble, could lead to a little something worse. So these are all the things that we're watching. Other than that, I don't see recession on the cusp right now. I will say, too, that the other thing that concerns me is that everybody in my industry is expecting a good year next year. Everybody. Oh, I'm hearing nothing but 15 to 18% earnings growth on the S&P 500. The AI trade is just getting started, so on and so forth. And everybody is in agreement that it's going to be a solid year. Not as much as we've had the last 3 years, they say, but it's going to be a solid gain year for the market. When everybody in my profession agrees, I get very worried because they're usually wrong. That also kind of has my attention. So I know this has been kind of scary and a little depressing and a little worrisome. I don't want you to be afraid. I'm sharing this information with you so you can be prepared and you can be in the know and be aware and not be alarmed when the crap hits the fan, if it hits the fan, which I expect it will in some way, shape, or form this year. Even if we don't have a bear market, even if things don't get really ugly, even if we don't slip into some sort of secular bear this year or the next couple of years, you're likely to have a really severe drawdown at some point in time this year when you factor in the fact that it is a midterm election year and we're getting a new Fed chair. I just expect things could get pretty ugly and the market's expensive going into it. So just be prepared for that. Be ready for that. No, David, if you're so worried and you're so convinced that this is going to happen, why don't you just sell it all? Because that is a fool's game to play, folks. That's just not how you manage money. I know we're pretty good at this, and I don't say that boastfully. I mean, we are. We've done good work for our clients over the years. I think we do a good job on staying on top of this stuff, but we do not have a crystal ball. We just do not. If I did, as much as I love you all, I wouldn't be doing a podcast on Friday night. I would be sitting on my island, formerly known as New Zealand. I'm serious, right? If I had a crystal ball, I mean, my gosh. So I don't have one. And you never want to gamble with your money. And when you go all in and you go all out, you're gambling. And we don't do that here. But we do lean into our convictions and lean out, okay? Lean in and lean out. We don't go all in or all out. So what we're doing here at B.I.G. is what we've been doing for the last few months. You've seen it. You've seen us trimming back these stocks. You've seen us taking some of these gains. You've seen us increasing cash, adding to bonds. Look, we've got simplified CTA managed futures strategy in here, which is a great diversifier during bad times. We're doing lots of things to create buffers in the portfolio, a little bit more international exposure, lots of different things. And we're watching the technicals closely. So we're keeping a balance. We're keeping some exposure to the U.S. market because let me give you some other piece of data. There's another time when the market was this expensive. There's another time when the market had 3 back-to-back years of double-digit gains. There's another time where everyone thought the market should break and go down and crash and all this. And guess what? It made 100% return in less than a year on the NASDAQ. That was the 1999 tech bubble, okay, 98 to 99. 100% gain before the crap hit the fan. So even though we might see the writing on the wall or have some concerns that this could be happening, there could be a lot of money to be made between now and when it actually does happen. So it's not a game that you play. You maintain balance and you just lean in or lean out. We're leaning out, folks. We're leaning out. And listen, I am quite all right, A-OK, absolutely fine and dandy with making less money in 2026 than the S&P 500, okay? We're in a luxurious position in which we can afford to do so. When you've beaten the S&P 3 out of 5, you can certainly take a breather and expect to make a little bit less. So if the market screams and rips higher and makes 20 and 30% return this year, great. Have at it, S&P. Have at it, Mr. Market. We'll do just fine. Maybe we'll make 7 or 10%. I'm okay with that. Market's up 20 and we're up 10 or 12. I'm happy about that. That's wonderful. But if the market veers off course, really crashes, really collapses, really takes a hit, and it's down 20, 30%, I want to hold what we've made here. I want to hang on to it, be able to make some moves and make some adjustments and do some buying when things are taking a hit to take advantage of the situation. I think the market, if you want to press me, what's the market going to do for 2026, David? There's a lot of competing forces right now. I would lean towards the idea the market's going to finish positive on the year, but I think it's going to be an ugly, bumpy ride. And I think there are going to be some real doozies along the way as far as declines are concerned. That said, I also think that we are in a precarious position overall, and my opinion on it finishing positive for the year could change very quickly. I'm going to know a lot more. I'm going to feel a lot more comfortable one way or the other in just a couple more weeks. Remember I told you that period, October to January, we were a couple weeks away from determining what this period looks like and what that might speak to for the market, because it's the reason why that's important. It indicates a change and a shift in sentiment in the market, and that can definitely carry forward throughout the year. So we're going to be watching that real close. So look, I love where we sit. I know it was not a happy-go-lucky sunshine and lollipops, that was for you, Ed, type of podcast. I got to be real with you folks. Got to tell you where I think we sit and what we're doing about it, and just know that you're in good hands. We're going to take care of it one way or the other. If the market wants to go up, we'll make money. If the market wants to get its teeth kicked in, we're going to hang on to the money. That's what the goal here is for us and our clients at B.I.G. So look, I know it's a long one. Sorry about that. It's a year-end podcast, a lot of information to cover. Wants you to have a good handle on what's happening and what we're thinking. But look, we're in great shape. So between now and next week meetings, you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's retire. Yeah, you'll still be able to do that. Maybe it's retire a little early. We can do that too. Buy that second house, take that big trip. We'll make it happen. Don't just think about it. Think big. Think B.I.G. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at B.I.G. Investment Services. For more information on B.I.G. and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.